I had a client come to me with a rate that they were so proud of. They shopped around, they did their research, and they found the lowest price on the market. What they didn't read was the fine print. Buried in their mortgage commitment was a clause that meant they could not break that mortgage until they sold that property. They saved $35 a month, and now they're completely trapped. That story is exactly why we're doing this video. Let's go. In the rate environment, the number on the page, it's only half the story. Here's what's actually happening with Canadian mortgage rates right now and what you should be doing about it. The Bank of Canada has held its overnight rate at 2.25% for the third consecutive announcement. Prime rate is sitting at 4.45%. And the rate environment right now, it's genuinely uncertain in a way we haven't seen in a while. Here's why. Fixed rates have been quietly climbing, not because of the Bank of Canada moved, but because bond yields have been rising. Geopolitical pressure, energy price spikes, inflation ticking back up to 2.4% in March, all of that is flowing through fixed mortgage rates. Meanwhile, variable rates, they're holding steady because prime hasn't moved, which means right now, variable is actually meaningfully cheaper than fixed. The best 5-year variable insured is sitting around 3.35%. The best 5-year fixed insured is around 4.04. That's a spread of close to 70 basis points. And that spread matters, and we're gonna talk about what it means for you. But first, let me make sure we're all speaking the same language, because your rate, it depends heavily on which bucket your mortgage falls into, and most people don't really know which bucket they're in. There are three. The first is insured, meaning you put less than 20% down on a property under 1.5 million. You pay a default insurance premium, but because the lender has that protection, you get the sharpest rates available. Right now, that's around 4.04 on fixed and 3.35 on variable. The second bucket is conventional insurable. You put 20% or more down, it's a standard owner-occupied purchase, and the property fits normal guidelines. You don't pay the insurance premium, but the lender can still insure the portfolio on their side. Rates here are slightly higher, think like 4.1 to 4.3 on a strong fixed file. The third bucket is your conventional uninsurable. This is where all refinances live, rental properties, properties over 1.5 million. The lender carries more risk in these situations, so you pay more. Expect to be in the mid to high fours on a refi right now, depending on the file. Keep those three buckets in mind because they change everything about your rate. Now, who actually needs to be paying attention right now? There's three groups. The first is anyone renewing in the next 12 months. If your renewal is coming up, get a rate hold and get your options mapped out today. Fixed rates are moving up, not down, and the window to lock in at current levels may not stay open for long. The second group is anyone sitting in a rate with a high 4 or a 5 in front of it. Run the penalty math, or your broker should have run this math for you. If you locked in at peak rates and the penalty is manageable, there may be a real case for a switch. Don't assume it doesn't make sense without actually checking. The third group is anyone thinking about pulling equity, debt consolidation, renovations, picking up an investment property. Lower rates do change what's possible, but only if the cash flow makes sense after the restructure. That's the piece that most people skip over. Now, let's talk fixed versus variable, because this is where I see people, they make the most expensive decision based on the least amount of information or consulting. Variable, it's cheaper right now, meaningfully cheaper. If the Bank of Canada holds at 2.25 through this year, which many economists expect, you save real money on variable. But here's the risk, the possibility of rate hikes, it's back on the table. Inflation ticked up to 2.4% in March, energy prices are elevated, and the bank has signaled it's watching so carefully. If hikes come in late 26 or into 27, variable rate holders are going to feel that immediately. Fixed gives you certainty, and you know exactly what your payment's going to be for the next 5 years, regardless of what happens in the world. The trade-off, though, is you're paying a premium for that certainty upfront. Neither is wrong, but the decision should be made deliberately based on your income stability, your cash flow, and how much uncertainty you can absorb, not based on which number looks better on a rate comparison website. Let me come back to my client from the start of this video, because what happened to them is the most important lesson in this rate conversation. They chased the lowest number and they got it. But that rate, it came with a bona fide sales clause that killed their flexibility completely. What that clause actually means is this: no matter what happens in your life, you cannot restructure your mortgage until you sell it. You lose your job, you get divorced, you want to access equity, or there's a better rate down the road, doesn't matter. You're locked in. And in an environment where rate hikes could be coming and your life could most certainly change, being handcuffed like that can cost you far more than the $35 a month you save. So here's what I actually look for on behalf of every client of mine: solid prepayment privileges, meaning you can put extra money against your mortgage each year with zero penalty. A reasonable break penalty in life if it changes. The ability to switch or restructure midterm if it makes sense. And flexibility when life happens, because life, my friends, always happens. A mortgage with all of these things at 4.1% is worth more than any mortgage at 3.85 with a bona fide sales clause. Full stop. So what should you actually do right now? If you're renewing in the next 12 months, get a rate hold today, please. And if you're in the high fours, most certainly 5% rate range, run the penalty math before you assume it doesn't make sense to move. And if you're thinking about pulling equity, make sure the cash flow works after the restructure, not just before. And if you see a rate that looks unusually low, find out why. Find out what you're giving up before you get excited. The number is never the whole story. The terms around the number are the whole story. Here's where things actually stand right now today. BOC on hold at 2.25, prime at 4.45, variable cheaper than fixed by about 70 basis points, fixed rates rising, not falling, rate cuts off the table pretty much, and rate hikes back in the conversation. This is not the environment to set and forget your mortgage. This is the environment to be extra strategic. Pay attention and make sure your structure is working for you and not against you. If you want to know exactly where you land, drop tune up in the comments and I'll run your numbers personally, your real picture, so you can make a real decision. And when you're done with this one, check out last week's video where I break down buying now versus waiting. I'll see you there.